30 years from now, I'm going to want my money working as hard as it possibly can to get the safest, highest, and most predictable dividends. But I also want my investments to grow in value too because, well, I don't want to run out of money. There isn't one best ETF that does all of those things, but I did some research and these are my personal top 7 ETFs for retirement passive income for your consideration. Let's get into our high yield heavy hitters first. Number 1 is JEPI, also known as the JP Morgan Equity Premium Income ETF. JEPI has 136 holdings and its top holdings include Amazon, Microsoft, Adobe, Progressive, Train, Intuit, MasterCard, Accenture, Visa, and United Health Group. JEPI has only been around since May of 2020, but if you invested $10,000 at inception, your investment would now be worth $14,277. JEPI has a dividend yield of 7.94% and an expense ratio of 0.35%. Investors can expect a monthly dividend between roughly 20 and 60 cents a month per share based on the past 3 years of dividend payouts. JEPI is a covered call ETF and works through equity-linked notes. The best way to think about how this ETF works is to think of a coupon. Let's say I have 100 shares of Apple and I wanted to use those holdings to get extra income. I could give someone the ability, but not the obligation, to buy those shares from me in the form of this coupon, also known as an options contract. Let's say Apple is trading at $100 and I give someone the ability to buy those shares for $101. The person that buys the option or coupon will pay me and I get to keep that money no matter what. This is what is known as the premium and is how JEPI generates such a high yield. The person buying that option contract is effectively betting that Apple will go above $101 and be able to buy shares for less than the market value, making a profit. This is a super simplified explanation of how covered call options work, and the strategy is obviously much more complex than dollar cost averaging into the S&P 500 or investing into individual dividend paying stocks. And a special note with this ETF, those options contracts are ran through a financial institution which protects the funds to some degree. So instead of having to figure out all the details of how options work and manage all the positions, you can buy this ETF and let the fund managers do it for you. But of course, this is higher risk, but does come with a higher reward. And of course, there's another ETF that works in a similar manner. Number 2, JEPQ, also known as the JP Morgan Nasdaq Equity Premium Income ETF. This ETF seeks to generate income through selling options and investing in stocks based on the Nasdaq 100 index, and like JEPI, also uses ELNs. JEPQ has 84 holdings, and its top holdings include Microsoft, Apple, Google, Amazon, Nvidia, and Meta, as well as its options holdings. This ETF was created in May of 2022, and if you invested $10,000 when the ETF was first available, your investment would now be worth $10,981. JEPQ has a dividend yield of 10.23% and an expense ratio of 0.35%. Investors can expect a monthly dividend between 33 and 57 cents a month per share based on the history of dividend payouts for the past year and a half. Now, this ETF hasn't performed as well as I would have liked since inception, but it is important to know that this is a tech-heavy ETF, and its price will correlate to tech stocks, which didn't have the greatest year in 2022, but did perform a lot better in 2023, so that can explain the price history. JEPI and JEPQ are higher risk and new ETFs with limited history, so they're probably not suited for every investor, especially during retirement for a lot of people. But they do offer higher yields, and I'm currently building positions in these two ETFs with the sole intention of more cash flow. Investors should know that they use a covered call strategy, which means that they can generate a massive dividend, but the strategy limits upside growth and can still capture downside risk. And these ETFs will do better in bull and flat markets compared to bear markets. I'll leave a link at the end of the video and in the description below if you're interested in my plan to make $100 a month in passive income from dividends. So if these are too high risk for you for your retirement plans, feel free to watch my portfolio instead. Our third ETF is VIG, also known as the Vanguard Dividend Appreciation Index Fund. The fund's goal is to track performance of the S&P US Dividend Growers Index, which are stocks that have increased their dividends for at least 10 consecutive years. So the goal isn't to maximize returns or growth, it's to focus on companies that have been growing their dividend. So instead of going out and researching the thousands of companies available one by one, this ETF does that for you. Top holdings for VIG are Microsoft, Apple, United Health Group, ExxonMobil, JP Morgan Chase, Visa, Johnson & Johnson, Procter & Gamble, Broadcom, and MasterCard. If you invested $10,000 10 years ago in November of 2013 and reinvested your dividends, your position would now be worth $25,700 $15,778 in November of 2023. VIG has a dividend yield of 1.9% and an expense ratio of 0.08%. For context, that expense ratio is relatively low, but compared to something like VOO that tracks the S&P 500 at 0.03%, VIG is more expensive, although not by much. Investors can expect a quarterly dividend somewhere between 47 to 86 cents based on the past 5 years of dividend payouts. Now, I know VIG isn't exactly the most exciting ETF available, but our next ETF has a much higher dividend and offers decent long-term growth that might be more in line with your needs. Our fourth ETF is SCHD, also known as the Schwab US Dividend Equity ETF. The fund's goal is to track the total return of the Dow Jones US Dividend 100 Index, which are stocks selected for their high dividend, consistency of paying those dividends, and are fundamentally sound compared to their competitors. Its top holdings are Broadcom, Amgen, Verizon, Coca-Cola, Merck, Pepsi, AbbVie, Home Depot, Texas Instruments, and BlackRock. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $26,329. SCHD has a dividend yield of 3.68% and an expense ratio of 0.06%. Investors can expect a quarterly dividend somewhere between 26 and 70 cents based on the past 5 years of dividend payouts. However, one huge issue with SCHD is it doesn't give investors exposure to real estate, and that's where our next ETF comes into play. Coming in as our fifth ETF is VNQ, also known as the Vanguard Real Estate Index Fund, and as you guessed by the name, this ETF focuses on giving investors exposure to real estate. This fund invests in stocks issued by real estate investment trusts, also known as REITs, or companies that purchase and manage physical property. Its top holdings are the Vanguard Real Estate 2 Index Fund Institutional Plus Shares, Prologis, American Tower Corp, Equinix Crown Castle, Welltower, Public Storage, Simon Property Group, Digital Realty Trust, and Realty Income Corp. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $15,734. VNQ has a dividend yield of 3.67% and an expense ratio of 0.1%. Investors can expect a quarterly dividend somewhere between 52 cents and $1.33 based on the past 5 years of dividend payouts. So one thing with this ETF is that by owning it, you don't get the full appreciation and tax advantages you can get by owning a piece of physical property, but this is a very hands-off way of getting exposure to the asset class, and you never have to worry about maintaining a property or worrying about finding someone to occupy the property and collect rent every month. Now, up until this point, we focused predominantly on US stocks. So in order to account for the rest of the world, that brings us to our number 6 ETF, VIGI, also known as the Vanguard International Dividend Appreciation ETF. The fund's goal is to track the performance of the S&P Global ex-US Dividend Growers Index. This means that it tracks stocks that are based outside of the US with a track record of growing their dividend for at least 7 years. Its top holdings are Novo Nordisk, Novartis, Nestle, SAP, Roche Holding, Sony Group, Toronto Dominion Bank, Sanofi, AIA Group, and Reliance Industries. If you invested $10,000 10 years ago and reinvested your dividends, your position would be worth $15,588. VIGI has a dividend yield of 0.98% and an expense ratio of 0.16%. Investors can expect a quarterly dividend somewhere between 3 and 65 cents based on the past few years of dividend payouts, but this can vary pretty significantly. I really like this ETF because as good as the US markets have done in the past few decades, it's important to remember that the global economy can shift, and if we're too invested into one country's market, that could put us at risk. Now, one huge thing with this dividend is that this is not consistent and not very high, so any money that I would personally put into this, I would consider as diversification outside of the US with a small dividend as a bonus. Stocks are fantastic investments, but when we're in retirement, we might want something a little safer to rely on, and that brings us to our final ETF, number 7, BND, also known as the Vanguard Total Bond Market ETF. The fund's goal is to track the performance of a broad market-weighted bond index. So the holdings for this ETF are bonds, and what a bond is effectively a loan. In exchange for the fund loaning money to corporations and governments, they get paid back in regular amounts with interest. So some of the companies that this fund is working with are Amazon, AbbVie, Apple, 3M, and even governments like the province of Quebec and in Mexico. The holdings for the ETF based on the website is literally thousands of pages long, so definitely check it out in the sources below. If you invested $10,000 10 years ago, your position would be worth $10,883. So definitely not an ETF that prioritizes growth, but consistency is always nice. VND has a dividend yield of 3.44% and an expense ratio of 0.03%. Investors can expect a monthly dividend somewhere between 12 and 20 cents based on the past 2 years of dividend payouts. The thing about this list of ETFs is that I think, generally speaking, they're all good options for a lot of different kinds of investors over the long term. But remember, returns and future performance aren't guaranteed, and I'm not a financial advisor and this isn't financial advice. In fact, it's impossible for me to give any individual advice through a video that's designed to be watched by a broad audience. And who knows, maybe there's better options, so let me know your thoughts in the comment section down below. Dividend investors should be aware that there are also some downsides to the strategy. First, dividends aren't guaranteed, so an individual company could decide to stop paying a dividend, and there's basically nothing us investors could do about that, which would be a problem if we're trying to live off of our dividends. Although the risk is less if you invest in dividend ETFs, or if that one company is only a small position in your overall portfolio. And in the case of a covered call ETF like JEPI or JEPQ, the dividends come from how much money the fund gets from its investment strategy, which is, again, outside of our control. In addition, if a company is paying money to investors in the form of a dividend, that means that the money is being given to investors rather than being reinvested into the business. So the claim is that the company will not grow as much as it possibly could since the money is leaving the business, which is fine if you're a dividend investor, but not necessarily fine if you're looking for the highest growth of your investments. And of course, dividends aren't free. Typically, when a dividend is paid out, the price of the underlying stock usually drops by that same amount. But for a good, stable, reliable company over the long term, this isn't a huge issue. But this can lead you to fall for a dividend trap where the yield is super high, but the overall value is decreasing, so watch out for that. And finally, dividends are taxable. So if you have these investments in a traditional taxable account like a Robinhood account, you will be paying taxes on your dividend payouts. Although you could look into Roth IRAs, which are tax-free retirement accounts where you invest money that has already been taxed up to a certain limit every year. If you're okay with all that and you're still considering dividend ETFs, at this point you might be wondering, how much exactly do I need invested in order to make $60,000 a year from my investments? So VOO is an ETF that tracks the S&P 500 and has a dividend yield of 1.44%, which means every year 1.44% of the overall value of the portfolio is paid out as a dividend. Assuming the dividend doesn't change and the value of the portfolio doesn't go up or down, you would need over $4 million invested. Compare this to something like SCHD with a yield of 3.68%, you would need about $1.6 million invested. That is significantly less money needed comparatively, although it is a good time to remind everyone that higher dividend yields typically correlate to higher risk. And with something like JEPI with a yield of 7.94%, that means you would need $755,000 invested. So with all that being said, this is a great time to consider all your options, your risk tolerance, future plans, and of course, speak with a professional about your investing and your retirement. So good luck in the markets. Thanks for watching, and I'll see you in the next video. Have a good one.